Welcome to today's economic review hosted by First Business Bank. I'm Bill Allman, head of the bank consulting group at First Business Bank. Today, we're going to talk a little bit about the economy and what's going on in relation to the Fed Reserve, our investment portfolios, loan pricing, and deposits. I typically have these meetings, quarterly with banks as we meet with ALCO or investment committees, board meetings, et cetera. But we've seen just really heightened activity in the markets with the Fed Reserve really being very aggressive, increasing interest rates at this point. So with the Fed Reserve, last week the Fed raised another 75 basis points. It's the third consecutive FOMC meeting that the Fed raised interest rates 75 basis points. And the markets are anticipating another 75 basis point increase in November and another 50 in December, bringing the Fed funds rate to the high upper bound of 4.5%. And the market has really changed over the last, really quarter. It really increased the terminal rate, meaning the high watermark where the Fed is going to raise interest rates to 4.5 to 4.75%. And going back to the June FOMC meeting, Chair Powell did point out that the Fed thought the neutral rate for Fed funds is 2.5%. And the market really took that the Fed was going to slow the pace of increases of interest rates. And since then, and particularly at the Jackson Hole Summit, the Chair Powell did note that the Fed is going to be very aggressive in raising interest rates to combat against inflation. So that brought the terminal rate really quite a bit higher here recently. And so again, the Fed is going to raise the Fed funds rate quite a bit above the terminal rate in order to bring inflation down. When you look at what the Fed had said at the last meeting, they're very clear that there's still a lot of work to be done with fighting inflation. So the Fed is really, again, just more rhetoric about the fact that the Fed is going to be very aggressive in raising interest rates. In the dot plot chart on the screen, the Fed voting members do indicate where they think Fed funds will be over the next 3 years plus the longer term. So pretty consistent in 22 and 23, you see the Fed is going to raise interest rates, the short-term rate, to that 4.75 type level. Beyond that, it's a little more uncertainty, the more of a shotgun blast here of the dot plots that the Fed members are not sure what's going to happen with interest rates and the economy after they bring inflation in check. The Fed also does their economic predictions, and you can see inflation is going to remain elevated really through the end of 22, 23, and into 24 before the inflation rate gets closer to that 2% target rate the Fed is trying to get to. And it also does show that raising interest rates is going to have a pretty negative effect on GDP. The growth should slow significantly with the increase of interest rates. Now, I do think the Fed is being a little optimistic with their predictions here. They're not predicting a recession at this point, but again, the Fed is going to be very aggressive, and it could tip us into a recession from a growth standpoint. Unemployment is also expected to increase. We can see through the end of the year a slight uptick to 3.8%, and then to close to the 4.5% level longer term. So from the investment portfolio standpoint, we've seen a pretty significant change in interest rates again here in the third quarter. The 2-year is up, when I ran this, up 127 basis points since June 30th, currently at a 423. The 5-year is up 100 basis points, currently at a 404. So quite a bit higher overall since the second quarter. The 2s to 10s, the 2-year to 10-year is also inverted. 51 basis points currently. So pretty significant inversion in the market. And you can see that illustrated in the chart below. And from the investment portfolio standpoint, it's a challenge for banking. When rates are low, we tend to have a lot of liquidity. When rates are high, liquidity is low. So we're in a high rate environment at this point. But again, liquidity is a little bit lower and loan demand has been somewhat moderate and strong for 2022. So investment portfolios are definitely under pressure still here in the third quarter. So we are going to reinvest securities today. Cash right now, the Fed is paying, I think, around 3.10. By the end of the year, we'll be at 4.25. So cash is not a bad alternative at this point, especially if you're having some liquidity needs and loan demand. The challenge with cash there is the cash does not have a duration. So we do anticipate some point in the future, and it's illustrated in the dot plots from the Fed, that interest rates will be lower at some point in the future. Once we get inflation under check, we anticipate then interest rates start to fall. And that's where you want to take some duration. So again, treasuries really out through even 7 years right now, you can get greater than 4%. So you can take some duration, take out very, very little credit risk and prepayment risk by going into treasuries. The other alternatives, I like agency CMOs, the VATM structures, which are very accurately defined maturities. Those are currently yielding, in that 4.75 to 5% range. And I try to buy collateral that is really out of the money, about 100 basis points. So that protects us against our prepay risk. And with the stated final of the VATM, it protects us against extension risk as well. So a nice structure, I think, in this environment. And then also tax-exempt municipals are a good place to put some money at this point. The curve is not inverted like treasuries. So you do have a steepening of the curve, so the longer duration securities in that 10 to 12 year range with a 21% tax rate are yielding 4.5% currently. So it's a nice place to take some duration. So really, with an investment portfolio, if you have the liquidity, we do like a bit of this laddered approach, having some short-term cash, laddered in some securities and some cash flow from the VATMs, and then take some duration with the tax-exempt securities. And one other idea which could work for some banks is the tax loss strategy. So essentially selling tax-exempt municipals at a loss and then replacing back out onto the curve. And really the main goal would be there is to replace the loss, the give up essentially over the next year. So again, something we could talk about in more detail. From a loan portfolio standpoint, loan growth has been somewhat moderate in 2022. Some good growth early on, seems to be softening a little bit here as interest rates have been increasing. So from a conventional loan pricing standpoint, we look at typically FHLB advances, maybe plus a 250 basis point credit spread. That would put today's pricing at a 663. So pretty high historical rate that we're seeing on some of the loan pricing. I think we're just getting used to 5% handles. So we're quickly now at 6% handles, mid sixes even, and then likely going to be over 7% by the end of the year. So loan pricing is under pressure. I think we need to continue to keep our eyes on where we're pricing loans in this market. And many competitors, when we're looking at the individual loan pricing, they may be pricing off their balance sheet. And what that means is their cost of funds are relatively low at this point. And so they're picking up credit spreads off their cost of funds, but interest rates definitely are going to, or deposit costs are going to be under pressure. So we're going to see deposit costs increasing significantly. So you want to be careful where we're pricing loans essentially on the balance sheet. And then credit. We want to make sure we keep our eyes on credit as the economy potentially weakens with the Fed activity. And then lastly, deposits. So this is really, I think, a lot of the discussion that I've been having with banks here more recently, in that banks really over the year modeled the betas at about 25% or less, meaning that as the Fed would raise interest rates, we would only raise our deposit rates about 25% of the rate increase. And with the Fed raising interest rates so quickly, really deposit rates are really under pressure. So banks are going to be, through the end of the year and into 2023, under pressure to raise short-term rates. Another topic that's been discussed quite a bit is CDs. So through the low rate environment, CDs had very little activity. Really, most of them were rolling off into money market accounts. And currently, we're starting to see a fair amount of activity in CDs. So it's a great way to pick up some duration in your deposits with some CD specials. And it's really widely anticipated that large banks are going to be a lot more competitive as we get into the end of the year and into 2023 with deposits. So we're expecting to see money market rates really increase significantly with the next few Fed hikes. So really, some of our strategies here is we want to kind of raise our base rates just accordingly, but not potentially across the board, but really want to exception price. So really look for our larger depositors to proactively offer them an interest rate to keep the deposits at the bank. And I think it's going to be important for banks to keep some of the excess liquidity they may have brought on from the pandemic and all the stimulus packages that were put into the market. In that that liquidity is going to be very important. We want to be maybe start to slide a little bit liability sensitive as we get further into this cycle. And then realizing that there's many alternatives for the consumer right now for deposits. So as I mentioned earlier, we're seeing short-term treasuries are yielding close to 4%. So deposit rates are going to be under pressure, and we need to continue to be competitive in the market. So again, thank you for your time. Again, reach out to me if you want to have any further discussions. I intended to just be relatively short and just give you a brief update, essentially what we're seeing in the markets.